Hello, fellow investors. This is InvesTips, and welcome back to another video. Today, we'll be going over 5 tips that I've prepared on how to find the perfect stocks to invest in. If you follow these tips, you'll be able to find the best companies that will allow you to get as much money as possible through investing in the stock market. So without further ado, let's jump right into it. So the first step to finding a successful stock is to find a sector that will grow. And a sector is just a category for businesses that produce similar products or services. This is the most straightforward of their tips today. So if the industry as a whole will grow in the future, the chances are many companies in this industry will perform better than the overall stock market. So think about when you're searching for stocks, what technologies will become in higher demand in the future or are in really short supply right now, because these are factors that are going to push the prices of this product or the services that this company has to offer up, and this will allow it to have more revenues in the future. So some ideas include renewable energy or biotechnology, artificial intelligence, since many things are becoming automated in the future, and for example, semiconductors, because they're in very short supply in the future and they're going to be needed for a lot of industries in the future. Intuitively, on the other hand, you should also avoid industries that you think might diminish in the future, things that will become phased out, or technologies that are just old-fashioned and won't become viable in the future. So now that we've found a sector that we want to invest in, it's time to narrow down to a specific company that we think would be best. So once you find the best sector, you want to look for the best performing companies that can outperform their competitors. And competition takes the form of direct and indirect competition. So direct competition is between companies who manufacture the same products or deliver the same services. And indirect competition is where they have similar products that might drive customers away from a company. So for instance, Netflix and Disney are competitors because they direct competitors because they both stream movies. But they also have video game companies such as Roblox or Activision Blizzard to compete with indirectly because they both drive customers away from watching movies during their spare time. So now that we've considered a company's competitors, especially its direct competitors, there's a couple of things that we can look out for that can make this company stand out from the rest of them. So the first of which is brand recognition. If this company is very well known, they're likely to be trusted within the community, and people are more likely to continue using the product more because they know that this company continuously delivers high quality products. So this provides the company with a stable and sustainable source of growth that can continue throughout the future, giving you good returns and the highest possibility of growth through your investment. The second thing you should look out for is innovation. So if a company has better products than other companies, or it has a new technology that makes it unique, this makes it something that could be very good going forward, as it can provide you more revenue. More people are going to be willing to buy this company's products. The same thing goes for price advantage. If the products are cheaper than their competitors, then more people will use them, and they're probably going to grow faster than their competitors. Finally, if all the other factors that I mentioned above are good, then you want the company to be successful for as long as possible, right? You want their success to be sustainable. You can determine this in part by considering the barrier of entry to the sector this company is in. So what do I mean by this? Some sectors have a very high barrier of entry, meaning companies have to invest a ton of money, a ton of time into becoming a possible competitor in this industry. So if an industry such as pharmaceuticals requires tons of capital costs and time to be invested into researching drugs and getting them approved by the government, this deters competitors from entering the market in the first place, and it prevents them from being as successful as the already established players that we've talked about earlier. And also, even if they do become successful, they're already a couple of years behind, so it'll take them a long time to become as good as the companies that are already existing. So definitely consider the barrier of entry, and if it is very high, then the companies that are successful right now can likely maintain their status throughout the future. So I just showed you how to evaluate a company's qualitative side of things. Now I'll talk about the quantitative side of things, the cold, hard facts about their financials. By evaluating the financials, you can clearly see how well the company is doing right now and whether or not it is in a healthy situation that will put it in a position to grow throughout the future. The 4 financial statements I'll be going over today are going to be the debt to equity ratio, the cost of operations, the PE ratio, and then finally looking at quarterly revenues. Alright, so in order to analyze a company's financials, we're going to be using Yahoo Finance, which I highly recommend because it has tons of very important and accurate information about all of the company's financials. So today we'll be looking at Apple, and here's the homepage as you can see. We're first going to be clicking onto the financials right here, right? Okay, so we're going to click on financials, and here we're going to see all the financial statements about Apple. You can see like the revenue, its profits, and lots of different statistics. So the first thing that we're going to be looking at is the equity to debt ratio. In order to see this, we're going to look at its balance sheet, right? We're going to go to the balance sheet, and essentially the balance sheet just shows you how much assets a company has and how much total liabilities it has. So assets are things that have value towards the company, and liabilities are debts that it has to pay off. So ideally we want a company that has more assets than liabilities, right? Obviously, because we want them to have value. So what we're going to do is we're going to look at the total assets. We're going to drop it down with the arrow right here. We're going to see the current assets. We're going to look at the current assets divided by the current liabilities. So we're going to drop down liabilities right here. And we're going to see current assets and current liabilities. So we're going to divide that out using calculator. Right? Okay. So Apple right here, we see that its current assets are 143,713, right? And then we divide that by its total liabilities right now, its current liabilities, which is 105,392. We divide that out, and we see that it is approximately 1.36. That is very good because hopefully we aim for a value that is greater than 1. Anything that's less than 1 is highly risky, and I would highly recommend you not invest in it. But anything that's greater than 1 is very good in that you should consider investing in. And anything greater than 3, I mean, it has much more current assets and liabilities. Those are like the best for people who are very risk averse. So if you really don't like risk, try to go and you really want to go on the safe side, then look for an equity to debt ratio of 3 or higher. Next, we'll be looking at the cost of operations of a company. And to that, we're going to go to the financials again and load up the statistics. This time, we're going to be looking at the operating income of a company, which you can see right here. In this row right here, we can take the trailing 12 months row right here and then the first column. So we're going to take the operating income divided by the total revenue of a company right here, and multiply that by 100% to see how much of a company's revenue is actually kept after like deductions and taxes and all that stuff, right? Okay, so let's pull out the calculator again. So this time we're going to look at operating income, which in the trailing 12 months is 88,903. And we're going to divide that by the total revenue, which we see here is 325,406. We divide that out, multiply that by 100, and you can see that 27% of Apple's total revenue is kept after deductions and all of that. So it has an earnings of 27%. And this is like exceptionally high, right? Usually you want to aim for anything greater than 15% is really good. So the higher number means that the company is more efficient with its revenue and actually keeps most of it that it makes. So you can see that Apple right here has a cost of operations of around 27%, and I think that is very good, and it's definitely an ideal percentage. So now we're going to be looking at the PE ratio, or the price to earnings ratio of a company, which is one of the most important things that you should consider when you evaluate a stock. This time on Yahoo Finance, we're going to be looking at the statistics part rather than the financials. So we're going to click here on statistics, and you can find PE right here. We're going to look at trailing PE, which is the past PE of the company, rather than looking at the forward PE, which is like looking into the future, like the predicted by analysts. So price to earnings ratio is essentially the share price divided by the earnings per share of the company. So the share price divided by the revenue or the profits of a company per how many shares in existence. So this is used for valuing companies to see how much they're really worth, whether their stock price is overvalued and undervalued. And this is most useful for comparing companies within the same sector, because PE ratios, they often vary a lot between sectors and other sectors. And really there's no ideal ratio when you evaluate PEs. PE is usually used for value investing, and value investing is where you look for companies that you think are worth more than the stock price indicates. So if you think that the company's shares are undervalued and you think that they're going to be corrected sometime in the near future, the PE is the number one statistic that you should look at. So a lower PE means that the stock is undervalued, right? Because the total revenue or the earnings per share is relatively higher than the share price, or comparatively, right? So this would mean that it is worth more than what the stock price indicates. And likewise, if the PE ratio is really high, it means that the stock is likely overvalued and it will likely drop in the future. So overall, try to look for the lowest PE among stocks in a certain sector, and that will give you the most value when you invest. This will allow you to have lower prices when you invest, because you're investing for less of a price of what the company is really worth. It allows you to buy more shares of the company at this time. And the last revenue statement that we'll look at is simply just the quarterly revenues over time. And this is useful to make sure that the company is growing and that it is maintaining its revenues and staying healthy. So what we'll do is we'll look at we'll change from annually here into quarterly statistics, and we're just going to look at the total revenue, right? So we're going to see how much revenue this company has had in the past quarters. And we see for Apple here, it started off with 58 million, then 59 million, goes up to 64 million, and then 111 million. Now this demonstrates clearly that it has sustainable growth over a couple years, and that it can probably maintain this growth into the future. So look for steady, even if it's small, as long as it's increasing over time, make sure that the revenue of the company is increasing over time. One thing that I want to note though is that what I'm giving you is just very rough general estimates that I use to when I invest. These are by no way really strict or binding, so you can just choose what works for you and see what financials that you think are valuable. The next tip is to pay attention to the press and the news. In general, good news makes a share's price higher and bad news makes it drop, as it influences whether or not the stock looks appealing to investors who want to invest in the stock. So there's a couple of things that we can look out for. First of all is acquisitions and mergers. These usually push stock prices up because they make the company get more competitive advantages, since first of all you remove a competitor and you get to absorb all of their advantages, but also it can increase your market share inside of an industry, allowing you to consolidate your competitiveness and to expand into a wider range of products and services. However, sometimes it could be risky because some mergers and acquisitions can hurt a company's prospects in the long term. So evaluate if you think that the merger or acquisition is good for the company and whether or not it will produce long-term success. Next, you should look at economic indicators. Now, although it may seem like these are completely different from stocks, they actually have a lot interconnected, right? You should look out for inflation, increases in consumer spending. You should look out for recessions and just overall economic activity because they affect all stocks. For instance, if inflation is really high, it would be very wise to buy gold to hedge against this inflation because historically it has been very stable. So look at economic indicators because these will affect the prices of all of your stocks. Next, you should look at the earnings reports of companies that you want to invest in, because good earnings reports attract investors who see positive prospects in the companies and think that they will continue to grow in the future. So a company with good earnings reports will likely grow, and one with very poor earnings reports, which has really high debts and few profits, is likely to be to not have its share price increase a lot. And just overall, having new products or services or a decrease in prices or new technologies, these are always good things for a company to announce and just to pay attention and keep an eye out for these kinds of news. And now onto our last tip for today, which is to take dividends into consideration. Dividends are when companies pay a proportion of their earnings to shareholders in an incremented period of time, so for instance every year, every quarter, or sometimes every month. And dividends can be a great way for investors to make passive income. So without doing anything, every incremented period of time, you'll have additional amounts of money deposited into your portfolio. This is a great way to make money without even actually having to do anything. Now, paying dividends, when a company pays dividends, is usually a sign of stability, especially if the company has paid them reliably for a long time because they have the excess profits that they're able to do it. However, if a company suddenly stops paying dividends or lowers the percentage of the dividends a lot, it could be a sign that the company is in trouble at the moment, although even if it may not persist into the future, it's good to consider this when you choose whether or not to invest in the company. So pay attention. If it has suddenly stopped paying dividends, it's likely the stock price is going to drop as the company's in trouble, so don't invest in these kinds of stocks. Also, be careful of very high dividends, right? These can also be dangerous sometimes. It can show that the company is very desperate for cash and is trying to lure in new investors. So if a company has artificially high dividends that you think that they cannot sustain for a long period of time, you should try to stay away from it. It also means that the company isn't investing enough in itself, right? And is instead spending all of its earnings on shareholders. So if it spends all of its money paying off shareholders, then they won't have enough to grow in the future and to invest in its own domestic operations. So that could be something that you should consider. So overall, dividends, although they can be really good for you in an easy way for you to make money, you should be careful of how high the dividend percentage is and how it changes over time. Thanks a lot for watching this video, and I hope you learned a lot. Today you learned how to find a sector that will grow, how to find the best company within a sector, how to evaluate a company's financials, how to pay attention to the news, and how to consider dividends when investing. By implementing these strategies, you'll be able to buy a stock before it grows and reap huge profits through your investments. I wish you the best of luck, and thanks for watching this video. Make sure to click on the link down in the description below and sign up for Wealthsimple to get 2 free stocks to begin your investing. Have fun investing. Thanks for watching.